This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It's Friday, January the 23rd, 2015. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates regional developments. Therefore, the slides this morning will focus on our other three report areas of the GMT report, the global risk factors, and the macro and U.S. economic developments. As I often do, I'd like to tie them together into a single discussion. I want to focus specifically on the cracks I'm seeing in the central banker's policy facade. In our last report, we discussed how the central banks were transitioning to another level of anxiety over whether their policies are working. At that time, I felt they were shifting from concerned to elevated worry. The cracks in the facade prove that to be, in fact, a correct assessment. I'd therefore like to discuss the following this morning. The 6 years of recovery and what have we got for it? Is there a pattern here? Inflation and deflation tectonics and what they're telling me? And the cracks and fractures that I think everybody is seeing. And then what I believe the central banks and the politicians will do next. After 6 years, I believe the central banks are, in fact, beginning to run out of runway. If we are 6 years into a recovery, why does the ECB, the European Central Bank, need to now initiate a 1.1 trillion euro quantitative easing program? We already had various versions of ECB programs of Litro and T-Litro, as well as numerous bank stress tests that proclaimed the banks had a clean bill of health. What has changed? Maybe the truth is nothing changed, and that is the problem. Nothing was ever solved, just papered over. It's now showing it isn't working. It didn't work. I have lost track after 7 consecutive quarters of recession which countries were out and back in recession in Europe. It doesn't really matter though. The EU is in recession and things are only getting worse. We are told quantitative easing is needed because inflation is too low and they need to fight deflation. When was it that inflation was suddenly good for people? It isn't. It is good for those with too much debt, such as the government and banks. Inflation is good for the people, such as plunging prices at the gas pump. So clearly the banks are still in trouble. When Germany's long-term bond yields are the same level as Japan's, you know the EU is in serious troubles. But nobody seems to want to talk that way. Unfortunately, quantitative easing and QQE in Japan didn't solve Japan's problems, nor will it solve the EU's. Can we expect the EU to start buying the stocks, the STOXX, through its public pension plans, as the Japanese public pension plan is doing now? Don't underestimate what may be in store for us as the central bankers do everything in their power to protect the moneylenders and thereby themselves. Japan is clearly showing the way in regards to the limits a government and central bank will go. Abenomics, by all measures, is failing, and only discussed and considered solution currently is to double down further. If Japan is in fact successful in achieving their 2% inflation target or goal, they will be unable to pay the interest on the bond prices it will require. I believe that is called checkmate. And that's giving them the benefit of the doubt that they can even pay their current level with the basic demographics. It's just simple arithmetic, and I've written about this previously. The truth is that it will never happen. Not that inflation will eventually go up, but that Japan's complete monetization of debt will continue, as will zero interest rates. It means the complete destruction of the currency. That is how countries go broke. They monetize their debt until their currency is worthless. The citizens are thereby robbed of their wealth. It is actually the citizens who go broke and finally, usually, often, revolt against the government. Only at that point. We are continuously told that the good news is the strength of the U.S. economy, which is the engine powering this global recovery. The story, however, is breaking down as this week the IMF once again took down its global growth forecast. They are, as usual, late to the party for various political reasons. Someone needs to explain to me how exactly the U.S. economy is recovering when the net new enterprise growth in the U.S. was a minus 70,000 firms in the last 6 years. This just released data from the Gallup Group supports everything we've been saying for some time. The Gallup study received almost no public visibility. It appears it just can't be true because it doesn't support the government storyboard. The monthly labor report, which everyone watches closely, or at least the headline numbers, shows job creation is coming primarily from what they call the birth-death ratio. This is the plug number that governments use every month that approximates what they claim is the employment coming from new companies that are starting up, net new companies, versus those falling. Someone is wrong somewhere, and in a massive way. The simple truth is everywhere. Ask any student, recent college graduate, or for that matter, anyone of working age. If you're fortunate enough to have a job that pays an actual living wage, it is as precious as having a government pension. Clearly, the storyboard is flawed. The global economy is now dominated by the emerging markets and has been since the financial crisis and its hot money explosion. This chart really shows it. But the story isn't good there at all. That is in the emerging markets. After building out capacity to match the expected demand brought forward by quantitative easing, because that's what quantitative easing does. It brings forward demand. And unless you sustain it, you have a big hole on the other side. It suddenly is finding itself in real difficulties, that is, the emerging markets, with slowing global demand. The fact is that the $9 trillion of carry trade created by the U.S. free money ended up outside the U.S. and over $6 trillion of it in emerging markets. How do you pay the debt when demand is slowing in your country? Especially when you borrow the money in U.S. dollars and those U.S. dollars are rising strongly as your currency is plummeting. The panic to cover or hedge their position in the emerging markets only makes the situation worse as the dollar rises further on their actions. It's a catch-22. Since the hot money flows peaked, the emerging market equities have been falling and seriously disconnected from the U.S. markets. Considering significant levels of the profits of the S&P 500 comes from emerging markets outside the U.S., it begs an awful lot of questions. Buybacks have been hiding the problem as top-line sales growth has steadily fallen, but earnings per share go up as the numbers of shares outstanding has been reduced. Nice little trick. Everybody knows it, but if the stocks are going up, you keep playing it until they don't. And then when it reverses, everybody heads for the exit. So what is going on? We laid out almost 2 years ago in our thesis paper entitled The Globalization Trap that expansive credit creates excess supply and excess demand, which eventually, at some point, will reach an equilibrium if rate of expansion is not increased even further, and that goes actually it takes on an exponential level. But what it does is it brings forward demand, which leaves a potential demand rate vacuum. Meanwhile, inflation reduces real disposable income, which reduces the rate of demand growth. Shrinking aggregate demand then reduces commodity prices, which leads to collapsing collateral values supporting credit expansion. Commodities are heavily used as collateral in credit creation. So, and the oil shock is to me only your very first sign of this. There's more to come, maybe not as dramatic, but in a steadily ongoing process. Central banks, by creating excess inflation, actually sow their eventual destruction by creating inflation. I think they know that. They just never anticipated that they would be doing it for this long, 6 years, and there's been no other assistance, either political or fiscal or public policy, as an alternative. The central banks have been simply handed the problem, and they just don't have the tools to fix it. If things are recovering, why is money velocity and capital expenditures continuing to fall? You'll notice it falls here in this chart during the recessions. It begs the question, actually, of whether we ever really left the last recession on a real basis. The chart from my friend Lance Roberts is very telling when you consider a polynomial oscillation fit for the GDP and velocity of M2 money stock. If we aren't in a recession now, then there is a very strong probability that one is going to occur sometime in 2015. The lower chart here shows the U.S. cycle indicator, and the time is right for just such a recession. The top chart shows the S&P 12-month bottom-up forward earnings per share estimates, and I think it concurs. In fact, it's a pretty clear signal. My colleague Ronnie Stoffel at Incrementum has a proprietary global inflation-deflation indicator suggesting massive disinflation is currently underway. Things, in fact, are contracting, irrelevant of what the government spin maestros want us to believe. As if this is not bad enough, we have the Fed applying monetary pressure by allowing the adjusted monetary base to fall. As Richard Duncan has been warning on our site for a year now, there is a liquidity problem in 2015 if the Fed does not announce another version of quantitative easing in the first half of 2015. When I talk about liquidity shortage, this was before the plummet of oil prices, which wipes out well over $500 billion in OPEC and non-OPEC liquidity flows. That number was based on $70 oil, so it is probably approaching double that by now. Oil had better rebound quickly, or this is going to become a very serious crisis. Signs are, however, that the oil and energy prices aren't coming back anytime soon. Certainly not before this liquidity crisis trap is potentially sprung. Actually, signals are that it is going to get worse before it gets better. The collapse in commodities reaffirms that we have this global slowdown. Many economies are highly dependent on commodities. These are indebted countries which are now facing difficulty making loan payments. The cracks are being seen everywhere. Issues with the Swiss franc peg were no secret. What was a shocker is how almost immediately after the Swiss gold referendum on maintaining the peg and selling gold to do it as opposed to actually accumulating or having a minimal 20%, the Swiss National Bank abruptly reversed course without warning. The damages are still being felt as far away as mortgages in Poland and the Central and Eastern European countries. It shows that the central banks are losing control and minimally are being blindsided. They simply do not have the control people believe they have. I expect other pegs to fall. The Danish krona is under stress, the Russian ruble has collapsed, and the Russian central bank has almost given up trying to protect it. Hong Kong is under stress, and how long will China allow the yuan to lose competitive advantage to the yen? It's dramatic. Job creation is paramount in China with goals of net 10 million jobs per year. Demand slowdown and too strong a currency are adding massive problems to the Chinese leadership agenda. The first priority they have is job creation. People hold them responsible for it, probably more so than any country in the world. And the numbers are astounding, the number of jobs that need to be created. You want to see what damage currencies can have? Look at the emerging markets. A strong dollar is crippling their currencies, which must be converted into U.S. dollars to pay U.S. dollar-denominated debt associated with that $9 trillion U.S. carry trade, of which, as I said, over $6 trillion ended up somewhere in that level area, ended up in the emerging markets. We said this would happen when we wrote about the echo boom in the fall of 2013. The hot money would reverse with taper and lead to a liquidity trap. This was the actual chart we showed. The only thing missing was the timeline. Most of the emerging markets in the peripheral nations now simply don't have the capacity nor to refinance or pay the debt. Asset seizures are likely laying ahead, and I think that is a part of the strategy that's underneath all of this. But I'll leave that for another day. When you were a kid, I'm sure you played children's games where someone cheated. One of the kids would always cheat. Some people cheat when they lose. Politicians and bureaucrats cheat by changing the rules. Expect the rules to change to make things work the way the government wants or expects them to work. Expect things like the following, but not limited to. The Fed will eventually start buying stocks, if they're not already doing that. Public agencies and pension funds will start buying stocks, which if they're not already doing it, many are. Government and Fed will start guaranteeing collateral to stop bankruptcies and defaults. More programs will come to drive interest rates even lower to finance growing government debt associated with a massive unfunded entitlement program and potentially a unfunded pension problem at both the private, the federal, and the state and municipal levels. Helicopter money being given directly to target groups, and you're likely not going to be one of those target groups. And I go on. This and more isn't imminent, but expect to see it in the future as the government becomes more and more aware it is trapped. You'll be shocked at what you will see. Just as if we had this discussion 4 years ago, you would have not believed where we're at right now, but we've accepted it. So what you have to remember is the same thing that we said 4 years ago when I and Ty Andrews used to do a program called Global Insights. We did it for 2 years, and we ended almost every show in 2009, 2010 with this chart. Never forget, throughout this turmoil, they will print the money. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approach. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2015 turn out to be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.